Cost of borrowing is going up with the intention that eventually prices will begin to come down. Hello, I'm Steve Eager.
Hello, everybody. I'm Heather Hayes. Consumers are a big part of the Federal Reserve's target with today's historic interest rate hike. The goal is to get people and businesses to slow down spending and cool down the economy, so we will suffer. Today's three-quarter-point rate hike will increase mortgage rates and make business, auto, and credit card loans more expensive. Businesses will feel the pressure, too, to slow hiring. Some will cut jobs. That will make consumers tighten their budgets. The question is whether it's enough to reduce inflation. Fox 4's Alex Boyer joins us with more. Alex.
Hi, guys. And the Federal Reserve Chair today also indicated that more large increases like the one today would be on the horizon, which also raises the increase of another recession. Now, keep in mind that today's move ultimately increases its benchmark short-term rate, which ultimately affects both business and consumer loans. I had a chance today to talk to economists about what this means for Americans already stretched thin. The Federal Reserve has signaled it's not done raising interest rates after Wednesday's three-quarter-point hike, the highest since 1994.
Should continue to temper growth and help bring demand into better balance with supply.
The idea is if it costs consumers more to borrow money, they will spend less, and that will help bring rising inflation down. The Fed facing criticism for not taking these steps sooner, but there are limits to what the Fed can do, and pressures like the war in Ukraine and supply chain problems in China have also driven up costs.
I think Chairman Powell has been very thoughtful and considerate throughout this process.
Dr. Brian Marks is an economist with the University of New Haven. He says part of the goal is to get to a breaking point sooner so consumers stop overspending, in part a result of trillions of dollars from pandemic stimulus money.
It reduces my disposable income if my wages are not keeping up or if my wages stay the same. So now I have to make choices.
Which in turn means consumers won't be willing or able to pay skyrocketing prices for things like a new car or new house. For example, the mortgage on a $400,000 home would go up by $500 a month with the rate increase. Instead, folks will be forced to focus on essentials like food and gas, which many Americans need despite the cost.
If it's a quarter of a tank, it takes over $100 to fill it up, and I just go from work to home.
We talked to a few people at the pump about the interest rate hike.
My family affect my economy, for pay the bills, everything is too hard at this time.
Still, Marx warns against riding the ship too quickly, raising interest rates too high, too fast, and economists fear a recession is inevitable.
We don't want to destroy demand in its entirety. But we need to figure out how to maintain a level of demand, at the same time address the supply side components.
Leaving consumers already stretched thin on edge.
Are they wanting us to go broke and file bankruptcy? Because that's what it's going to end up happening. We all need pay raises, and that's not happening.
And even if a recession can be avoided, economists I spoke to say it's almost inevitable that the Fed will have to inflict some sort of pain, most likely in the form of higher unemployment, as the price we'd have to pay for defeating this record high inflation.